All right, let's take a trip back in time to 2016. Why? Because we're going to dissect one of the biggest economic stories on the planet, China's massive energy market. We've got our hands on a really fascinating market report from that year, and we're going to use it to break down its incredible scale, the key players, and, what the experts thought was just around the corner.
So get this. In 2016 alone, the revenue from China's energy sector hit an absolutely staggering $2.26 trillion. I mean, that's the kind of money it takes to power a nation of over 1 billion people. But a number that huge, it's kind of hard to wrap your head around, right? To really get a feel for it, we need to see how it stacks up against the rest of the world. Okay, so check this out. In 2016, China's energy market was more than $500 billion larger than the entire North American market, and that's the US, Canada, and Mexico, all combined. This really just puts the sheer scale of China's energy appetite into perspective. It was a giant.
Now, a market that massive doesn't just pop up overnight. So what was the engine behind this incredible growth? How did it get so big? To figure that out, we've got to look at the years leading up to 2016. Between 2012 and 2016, the market was growing at a pretty healthy clip, about 4.4% a year compounded. But you can see it wasn't exactly a smooth ride. There was this sharp dip in 2015, which the report chalks up to what it calls economic turbulence. To be specific, the Shanghai Stock Exchange lost 1/3 of its value in just 1 month. The fact that the market bounced back so strong in 2016 just shows you how volatile, but also how powerful this period of expansion really was.
Now, for a little context, let's look at North America during that same time. It grew at a much slower, steadier 2.7% per year. Yeah, it also saw a little dip in 2015, but the overall picture is way more modest, less volatile. China was just on a completely different track, a faster and definitely bumpier growth path.
So who exactly was running this multi-trillion-dollar machine? Well, the answer isn't a bunch of small companies. It's a handful of absolutely colossal, state-owned enterprises.
The whole market was pretty much dominated by these titans: CNPC, Sinopec, China Shenhua, and PetroChina. And you've got to understand, these weren't just companies in the typical sense. They were basically instruments of national policy, controlling huge parts of the energy supply chain, from drilling for oil all the way to the gas pump. To really get how they worked, let's just zoom in on one.
The report itself points us right to PetroChina. It literally says it played a dominant role in the industry. Now, PetroChina is the publicly listed part of that even bigger giant, CNPC, so its performance gives us this fascinating window into the kinds of pressures these state-owned titans were dealing with.
And this is where it gets really interesting. This chart shows the immense pressure these giants were under. I mean, look at this. While their revenues were going down, their profit margins just fell off a cliff. They plummeted from 5.3% in 2012 to just 0.5%, 0.5% in 2016. What's behind that? Well, it was probably a mix of falling global oil prices and the government influencing prices at the pump. It's a super clear sign that even for a state-backed titan in a booming market, actually making a profit was a serious challenge.
Okay, so this brings up a really fascinating question. What does competition even look like in a market that's dominated by just a few state-owned players? I mean, you'd probably assume it's not very intense at all, right? Well, the data tells a completely different and pretty surprising story.
Take a look at these two diagrams. They map out all the forces of rivalry, one for China and one for North America. And the similarity is just striking. In fact, the report says the degree of rivalry was strong in both markets. So yeah, China's state-owned giants were competing fiercely with each other, mostly because they had high fixed costs and were selling basically the same stuff. Gasoline, coal. It was a lot like their private sector rivals were doing over in the West.
But there was one really key difference. While the rivalry among the big players was intense, the threat of new companies actually breaking into the market, that was only considered moderate. The report mentions the government was starting to signal a partial liberalization, which hinted that maybe, just maybe, foreign companies might be allowed in through partnerships. So the door was mostly closed, but you could see it starting to crack open, just a tiny bit.
All right, on to the final piece of our puzzle. You know how every market report has to end with a forecast? So let's put ourselves back in 2016. What did the future look like for this absolute behemoth of an energy market?
Well, the prediction was nothing short of explosive. The report forecasted that the market was actually going to accelerate its performance. They predicted it would grow by over 41% in just 5 years, hitting an incredible $3.2 trillion by 2021. That's a vision of an already massive market about to kick into an even higher gear.
Of course, that was the view from 2016. And as we all know now, the years that followed were anything but predictable. That forecast was made before all the major trade policy shifts, before a world-altering pandemic, and before this huge global push for green energy really took off. Which leaves us with one last, fascinating question to think about. How did reality actually measure up to that 2016 forecast?